Today I have a masterclass in price action trading for you, and I will show you the most important signals that I love to trade on a daily basis. And we're starting here with trading breakouts and how do you trade successful breakouts with a breakout buildup. So what we have here is the market in an uptrend, and in an uptrend we typically want to observe how the market is reacting to important support and resistance levels. When we look at this level and this overall chart, we can see the market reach this high here once, then the market sold off. We have a fake out where the market is rejecting this area. We're coming back into the level, but this time when the market is hitting the resistance, the sell-off is much less strong. It's much weaker. We're not reaching the lows here. We're not even coming close to the lows. And then the market is really sticking to the level the next time. If there's a breakout occurring, this is a very, very strong bullish signal because it shows us that each time the market is hitting the level, there's less and less selling interest. So on the breakout, this is a great buy signal that we can get here. The market really stuck to the level. The market was not selling off. There's no more sellers left. And this shows us that's a high probability breakout scenario. Next, let's talk about stop runs and specifically liquidity hunting around key levels. So what we see is the market was in an uptrend. Then we enter a sideways distribution. A distribution is different from a correction. Typically in uptrend, you have periods where the market is going against the trend direction. We call those corrective waves. However, if a corrective wave is taking on and keeps going for an extended period of time, we're not talking about a correction anymore. We talk about a distribution. This is where the sellers are taking over and the buyers are leaving. So the people who bought up here are taking more and more profits, which means that fewer and fewer buyers are left in the market. We have a breakout level, and now let's put us into the shoes of the sellers. Where are going to have the sellers their stop? The stop loss is typically above the breakout level. So somewhere in this area, you're going to see a huge cluster of stop loss orders. And then what often happens is the market is pulling back into the level, which is called a stop run because the market is really hunting for the stops. And then we want to wait for a strong reaction. We don't just enter when the market is hitting the stop zone, but typically you wait 1, 2, 3 candles until you see a very strong bearish candle. That's your signal to sell. It shows you that the stop run is activated and then the sellers are coming back into the market. So here you can see we have a short pause after the market is hitting the stop zone, and then you have strong selling coming into the market. In that case, you can find a short entry in the stop zone. We're not taking the absolute high, but we're getting very close. The key is here really waiting for the selling pressure coming back into the market. And then you can see the short bias that we had after the distribution, after the breakout unfolded. But you really want to be mindful of stop runs because they happen quite a bit. And if you've been struggling with breakouts, this could be the cure. Next, let's talk about order blocks and how we can trade order blocks with a pullback approach. So what we have here is that the market had a very, very strong uptrending phase. So really the market shot up higher here in pretty much a straight line. There was some catalyst that acted here and that drove the price higher. This is the origin of this up move. Some traders will call this a demand area. Other traders will call this an order block. It's not exactly the same, but it's really close. And the key is what is behind this concept. This is the origin. And we want to look for those origin of those big moves. Then the market is coming back into the level. We don't trade those reactions blindly. We want to see that the market is reacting. So we are waiting for a bullish move. In this case, the bullish move is coming in form of an inverse head and shoulder with the left shoulder, the head and the right shoulder. We're breaking the structure. So the price is breaking about short-term resistance. That's our clue for a breakout. You can even see that we have a very quick stop run here. After the breakout, the market pulls back and immediately shooting higher. So the sellers are not strong at all in this case, and the buyers are really taking over here. And then you can approach this with the breakout long entry. For a target, you could look here for this fair value gap that was created on the way down. Stops can be placed anywhere below this area for a safe stop loss or more aggressive, closer to the breakout area. And then you can see the market is pulled into those areas. There's a huge gravitational force behind those fair value gaps, but also behind those order blocks. That's why they work so well. Next, let's take a look at how we trade fair value gaps with a break and retest approach. So what we see is the market is overall in an uptrend, and an uptrend unfolds in this way that we have impulsive waves. We have a correction phase. The correction phase has to be shorter than the impulsive phase. That's how the market moves higher. So we have strong buying We have selling, but not as strong. Then we have another push, very strong buying. The buying is getting us above the previous highs here. So it's continuing the uptrend. And then we have the next correction phase. Where's the correction phase finding support? In this fair value gap. This is a fair value gap because it's a very strong green candle, and the candle before and the candle after that, they don't overlap. So essentially we have this gap created, although there's no physical gap. The market is moving into this area, and what we want to see is a reaction. Again, we don't trade those levels blindly. We want to see a reaction. So we need to get some confirmation around those areas. The confirmation comes in this form of a strong breakout. You could also wait for a stop run. However, if the market is really strong, and we already have seen here the bearish phase, very often the market is not looking back. And you can see the market is shooting higher, and the uptrending structure is continued. Strong bullish, weak bearish, strong bullish, weak bearish, strong bullish. And this is typically how trends unfold. So it really pays off to study those core impulsive waves and then study as well where those corrective waves find support, and then anticipate how the next impulsive wave will play out. Let's talk about triple tap, which is an exhaustion pattern, and we want to look at exhaustion reversals and how we can trade them. So a triple tap occurs in an uptrend. We have 3 consecutive higher highs, but each high is less strong than the one before. So whereas previously the market moved up higher very easily, from here to here as well, and then from point 1 to 2 and from 2 to 3, we see that the market is really struggling to push higher. It's very different from how the bullish trend unfolded in the previous example, right? In the previous example, the market easily pushed above previous highs and continued the trend effortlessly. However, here we're seeing a lot of weakness. This is not enough to sell yet, but it's the first important indication that something is changing in the market dynamics. Then this is what we are waiting for. We see that the market is failing to reach point 3. So here we are not even making a higher high. We are starting to make lower highs. And then we see a strong bearish candle. This is the strongest bearish sequence that we have observed in all of this uptrend. So it's a significant market change. We are also for the first time breaking previous lows. So we are making lower lows here. Then the market sells off. We have another corrective phase. We have a pullback. The pullback pulls into this fair value gap here. We find more resistance. And again, it's really important that you wait for the market to show you signs of trend continuation. We see the market is showing a lot of selling here. We have also a lot of candlesticks wicks to the upside, which means that the market pushed higher but gets rejected every time. So there are some buyers in the market, but each time the market is moving higher, the sellers take over and drive the price down. And then you have another push to the downside. So the triple tap is a great exhaustion pattern that can often foreshadow long-term trend reversals. And then as a trader, we are looking for continuations in the new direction. Now let's take a look at liquidity hunting, and we're going to take a look at price divergences. So here we have a price divergence. We're in an uptrend, and when we look at those highs from here to here and from here to here, what can we see? Whereas previously from here to here, the market covered a large distance, so the price shot up higher. From here to here, the distance and the highs are much weaker. The market is not able to push higher as strong as it did before. It's very similar to the triple tap, and what we see is that the market is losing strength. Those are very important first indications that the price and the trend dynamic is changing. We don't want to short when the market is close to a highest high point. We really want to see that the market is taking and changing directions. When we zoom out, we can see that we are hitting external liquidity. When we zoom out a few days before, the market made this huge high. And all of the people who bought up the market here will have very likely their targets around this area. So there's going to be a lot of targets around this area. And what does it mean? The people who bought up are looking to exit the trades. And when buyers exit their trades, what they do, they sell. And this increases the selling pressure. So now we want to carefully observe how the market is reacting. We already see that the price is slowing down. Then we have the breakout structure. We see the market is making a lower low here. We see the weakness in the highs. The market did break a low here in the past as well, just recently, but continued higher. What's the difference? The difference is the external liquidity. The market was pulled into this area. A lot of traders were looking to take shorts here and exit their trades. And very often, the market and the price is pulled into those areas, whether it's a fair value gap, a big supply and demand area, an order block. Those are really important levels that the market is often pulled into. And then we have a very similar outcome. The market moves lower, we pull back, hit the fair value gap here, sell off, and then the market is turning directions. So it really pays off to mark those big levels on your charts and then carefully observe the price action around those areas. Not always will you see such a strong reversal. However, if you stack the confluence in your favor and if you wait for multiple signals around those areas, you can often find great signals. And let's take a look at trend exhaustion and let's see how we trade reversals in a different way. What we see here, the market in an uptrend, the market pushed higher, sold off, and is now pushing higher again. However, if the price is failing to reach a high, what does it tell us? It tells us that it's not as strong as it used to be. Also, look at the correction phase. The correction was quite strong here. So we see a lot of weakness here and a lot of selling interest in the corrective wave. So putting this together, if the market fails to reach the highs and we have strong selling, that makes more selling in the future even more likely. And you can see that a few candles later, we see strong selling once again, highlighting the high probability of the market rolling over. The market failed to reach the high, no continuation. We already saw a foreshadowing of the selling interest here, and then the market collapses. So those are all really important signals, and you can apply them in your trading. You can combine them in many different ways, and the different concepts, they really work very nicely together. Look at the big picture, mark your levels, look at impulsive and corrective waves, look at trend strength, how easily is the market pushing into a new high or a new low, do you see weakness in the market, and then you can improve your price action trading. If you like this way of trading and if you want to learn more about price action strategies, support and resistance, supply and demand, liquidity, and many other trading strategies, then check out my new trading program, which I call the Tradeciety. It's the ultimate trading program. I have a brand new trading course with over 80 videos. I constantly add new videos. You also get personally mentored by me, and you are joining a private community with a live chat room where you can always interact with me every single day. I also hold live webinars every week where you can look over my shoulder, ask questions, and interact with me. I have brand new trading strategies in the Tradeciety which have never been shared anywhere else before. Hundreds of trade studies, hundreds of chart studies, hours of backtesting. It's ideal for swing trading, day trading, and I basically show you how to trade all the different time frames. It works for Forex, commodities, cryptos, indices, and we even have stock traders in there. If you're interested, check the link in the video description where you find all the information about the special program, and we currently also have a special offer for you. So if you are fast and you want to join, then make sure to check the link, use the discount code, and then I will see you in my new program.